Okay, this is a typical trade of the early New York box model, which is where we get acceptance below one of the two landmarks. We pull back into a naked wick fair value gap, ideally discounted above the 50% fib. We place a stop beyond a thrust candle to be protected, and we target one pip or tick underneath the low. IPDA Concepts, the early box New York trading model. What you see in front of you are the results of the trading model that you're going to learn today. I've tested this throughout an entire year. As you can see on the screen, I will be showing you the details in a second. These are the results in terms of R. This is by risking 1 R per trade. And once again, what R means depends on how much you're risking per trade. But this would be the results of a 1 R risk. And you can see that although widely profitable, as you can see, you do have losing months, such as April, July, June, November. Right? You have 4 out of 12 losing months. You have an average of 11 trades per month. So do not expect to trade every day because it's not going to happen. And your win rate fluctuates between 50 to 58%, I would say, on average, considering all these months here, a 12-month period, which is good enough for a test in terms of a module testing. So we're going to learn everything about it today. This is just another quick example of the backtesting that I've done, the variables that I've tracked, such as active management versus not doing anything, screenshots of the trades, the fill time, the news time, the outcomes, did it goes to GP before filling, what does that impact to? Everything is covered in this module, and you're going to get it all packed in this video. So let's dive right into the model. The model principle is rather straightforward. You're going to denote a range from 7 a.m. till 9:30 a.m. New York Eastern time zone, obviously. You will have to convert that to wherever you live, but you will have a box denoting the range high and range low of the 7 a.m. till 9:30 range. Now, mind you, although the range goes from from 7 till 9:30, your trading hours go from 9:45, which is 15 minutes after the NYSE open, up until the 1 p.m. New York Eastern time. Now, mind you that 1 p.m. Eastern means that no trade can be filled after 1 p.m. New York Eastern time, but you can have trades that run longer than 1 p.m. New York Eastern time. Although through my testing, it is, I wouldn't say it's very, very rare, but it's the minority of trades will run further than 1 p.m. New York Eastern. You're only going to trade 2 setups, which is acceptance and rejection, and we're going to be getting into the details of them in a second. You're going to avoid the news with this module, which is to say that no trade can be filled prior to 15 minutes ahead of Fed forward news, and obviously you have to wait 15 minutes after the actual news release before you can get filled on a trade. So if you had orders 15 minutes ahead or 15 minutes after, you will have to cancel them until the 15-minute threshold is over. And trust me on that, I've tested this model for over a year, so I know the statistics of it, and these are the best rules that you can apply. You're not going to trade FOMC day. I mean, it's not to say that you cannot trade it, but on the testing of the module that I've done, I've always skipped the FOMC day. Now, mind you, we have FOMC day where we have interest rate decisions, and we have just FOMC minutes. I have tested this module throughout FOMC minutes, and you can trade it with this module. It does not impact the profitability. However, I cannot speak about the FOMC actual interest rate day because I've not tested it. You're going to be using the 5-minute and the 1-minute time frame only. So once again, what you see here on the top left is the range that you're going to be looking for. 7 a.m. till 9:30 New York Eastern time zone. Moving on, setup number 1, which is once again rate acceptance. We're going to be going through the details. I'm going to be showing you trade examples, obviously, and everything is going to get cleared by the end of this video. So you have to make sure that you stick to the very end. Let's go through this, shall we? You're looking for acceptance below the range lows highs, right? So in the box, you're looking for candles to close below or above the range high and low. Acceptance is defined by at least 2 consecutive candles closing outside the box on the 5-minute time frame. Displacement into the acceptance is needed. You're entering on a pullback into a fair value gap naked level that forms with the displacement. And once again, guys, I know that this may sound confusing as of now, but everything is going to get clear as we go through the examples. So you do not need to worry. Your target is always 1 tick below above the candle that initiates the pullback. And once again, we're going to be getting into that in a second. If there is no clear displacement, this is the key to avoiding a lot of losses that will come with this model. You do not take the trade. And there's a little bit of discretion there, but you will see what I mean in a second. This is a trade using the rate acceptance setup. Once again, we mentioned that we will be trading 2 setups. This is the first one that we've explained, which is rate acceptance, a bearish example of it, which is to say, and this is where we get into the nitty-gritty. This is the box that we spoke about from 7 a.m. till 9:30 Eastern. We're looking for acceptance above and below the range. We get acceptance above, but you can see that there's no clear displacement, so you avoid it. And then we roll over and we get, obviously, acceptance lower, right? This is what you want to see. We close below the range lows here for consecutive candles with clear displacement. Once you get that, you're going to flip the impulse, the displacement from the leg high to the leg low, and you're going to look for a naked level fair value gap to lean on as an entry point, okay? And this all needs to happen within 9:45 and 1 p.m. Eastern time, okay? This is the key as well. You need to wait for these timings of the market to make it work. So we understand that. How do we enter? We said that we would enter on a pullback into a fair value gap or a naked level. In this case, we have a fair value gap here. We have a naked level here. So you're entering there. And your stop, once again, does not go above the swing. Okay, I've talked about this concept numerous times now. It goes above a thrust that closed through a level. This bearish candle here closed below this low here and below all these lows to the left of it. So my stop loss goes above this candle high and not above the swing. Now, as we said, we're going to be targeting 1 pip underneath the pullback leg that takes us into the trade, which would be down here. Okay, this is a typical trade of the early New York box model, which is where we get acceptance below one of the 2 landmarks. We pull back into a naked wick fair value gap, ideally discounted above the 50% fib. We place a stop beyond a thrust candle to be protected, and we target 1 pip or tick underneath the low. Now, mind you, I've tested this model only on the NASDAQ, and you're free to test it on any other asset that you would like to trade. But keep in mind that these are the rules, okay? This here that I've written is the same that you're seeing here. Okay, I want to make sure that this is clear because I don't want you guys to be confused. This is now a bullish example of the model. We have the range. Once again, we clear the range low first, but do we get acceptance and displacement underneath the range low, which is obviously here? The answer is no, right? We just rate it and move further up. At that point, you're waiting for 2 consecutive candles to close outside of the range high, which is here. We get 1, we get 2. At this point, you're then waiting for a bearish candle. Once you get that here, you're then drawing a fib from the impulse low to the impulse high, and you're looking for a naked wick or fair value gap to go long. You can see there, this is the very exact same trade that we had on the bearish example, just flipped the other way around for bullish, which is to say we get acceptance, we pull back into a fair value gap here, which is also a naked wick with a 50% fib. We place our stop beyond the thrust here, which is not the same as placing it underneath the swing. That will impact your profitability quite a bit. And you target 1 pip above the high that created the pullback. Okay, very simple rules. There's no discretion here. This is something that you can trade for the rest of your days and be happy and proud. Now, you will have to go through drawdown. That is guaranteed. As you saw in the statistics, we had four out of 12 losing months. So very important that you understand that you will face drawdown periods. There's no strategy out there that doesn't have them. So keep that in mind. If anyone is telling you and selling you the idea that you can trade without drawdown forever, you should probably look to listen to someone else. The setup number 2, rate rejection. Sweep of the box high or low and close back below or above. Wait for a 5-minute fair value gap to form. Once it forms, jump into the 1 minute for refinement, entry point, stop loss placement. Your target is always buy side or sell side liquidity below above the pullback leg you entered on. Okay, very confusing. Let's dissect this. Same scenario, guys. We have the range low here, remember, from 7:30 till 9:30. We get a close below, move back up. Nothing to see there. We then close back below. And once again, this is the 1 minute, but you need to be looking at the 5 minute. The 5 minute needs to show rejection underneath the range low and a bullish closure that forms a 5 minute fair value gap. So this movement up here forms a 5 minute fair value gap. Until the 5 minute fair value gap forms, and you will see that in a future example clearly, you're not looking for this reversal, okay? So once the 5 minute candle closes and there is a 5 minute fair value gap, you're gonna jump into the 1 minute for the fair value gap refinement. You're gonna apply the same principle, which is to say you're gonna place your fib from the swing low to the swing high. You're gonna look for a fair value gap naked level discounted. We have this one here. And you're gonna look to target a buy side liquidity pool above the pullback leg that took you into the trade. So this is the pullback leg that took you into the trade. You're going to target the next visible pool above it, which in this case was the range high here. Okay, very simple mechanic to understand. You're waiting for a 5 minute fair value gap to form after we reject the range lows in this case. You're then jumping into the 1 minute for the refinement, and you're targeting the next visible buy side liquidity pool in this case above the pullback leg that took you into the trade. Simple. This would be a 5 minute bearish example so that you can see the 5 minute. I wanted to bring up both here. We have the range highs here. Once again, when you look at this particular day, you would have taken a short here. I don't want to disguise losing trades because they will happen, but you would have gone short here and you would have lost. Okay, you had clear displacement below the range lows. You have a nice naked wick with a fair value gap to lean on. You would have placed your stop loss above this thrust and you would have lost the trade. Okay, keep that in mind. But the screenshot here is to show you the example of the rate rejection. This is the range high that we need to pay close attention to. We close above, but we don't accept. Remember, it needs to be 2 consecutive candles. So we close back below, nothing to do there. We close strong bearish. At that point, you're already anticipating a rate rejection trade, but you don't do anything because you need to wait for a fair value gap. If this candle closes, now you have a fair value gap from here to here. And this price point here is a 1 minute refinement of that 5 minute fair value gap. Stop loss beyond the 5 minute thrust, and target the next visible liquidity pool underneath the pullback leg that took you into the trade. This is the pullback leg that took you into the trade. This is the next visible pool underneath it. Very, very simple module. Trade management, general rules. You only manage your trades as it goes into profit, not into drawdown. You're trailing your stops with candle confirmations. Rate acceptance, you're using the 5 minute candles for trade management. Rate rejection, you're using the 1 minute candles for trade management. You're trailing your stop loss as candles form thrust candles that close beyond structure. We're going to be getting into that in a second. And you're getting more aggressive the closer you are to target. Let's see an example here. This would be an example of a trade management, okay? So by now, everyone should understand that this is a rate acceptance trade. Firstly, we close below the range lows, but we don't get acceptance because we said it needs to be at least 2 5-minute candles closing below the range low, which would be here. So we wait for the opposite pull. We get clear acceptance above the range highs. We draw a fib from the high to the low. We look for a 50% plus POI discounted. In this case, I went for this fair value gap here as the entry point. And you can see that it ended up being a loser. But considering the trade management rules that I've given you, your stop loss by this point would have been here, below this candle wick. Once again, let's play through this trade. We get filled here. We move lower. As we said, we don't manage to trade and drawdown. We move up and down. At this point, we close with a thrust candle above this minor high here. And at that point, I would say it's fine to move your stop loss below this candle low here. You don't do anything then. There we get a bearish candle, so we know that structure is forming. And as this new candle drops down, fills the fair value gap, closes at a new high, the key here being closing at a new high, your stop loss goes here, below this candle wick low. In this case, although a losing trade, you would have pretty much gone out at break even. Very important. Do we have anything else? We have a trade management example of a rate rejection. We said that we would look to manage on the 1 minute on the rate rejection trade. Forget about the fact that we get the rate rejection here, which is a 5-minute fair value gap forms here with this leg down. You're then looking to enter on the 1 minute. If you see no fair value gap, you can stick with the 5-minute, which is what I did here. And I'd entered here. My stop loss above this thrust. My target is actually wrong here. It should have been underneath a pull here. But it doesn't really matter because I got stopped out anyways, right? Why did I get stopped out? Well, this bearish candle here is a typical example of a thrust candle. It's a wide-ranging candle that closed below this low. And at that point, my stop went above this area, above this high there. And that was the trade management. The market moved into profit with a big thrust below structure. I moved my stop loss. The market came back up, took me out at break even, and then dropped lower. Once again, the target would have been the next liquidity pool underneath this low. So yeah, hopefully you guys enjoyed this module. I tried my very best to make it as simple as possible to understand. These are the results. You can test them for yourself. And I will see you guys in a future video. Take care, everybody.